Welcome to the continuation of our lessons in accounts. We are continuing with final accounts. We are going to take a look at trading accounts. So the final accounts are basically three. There is the trade account, which looks at the performance of the business. Then there's also a profit and loss account, which looks at the profitability of the business. Is the business making profit? Then finally, there is a balance sheet, which looks at the financial position of the business. How much money is the business having? How much money is the business owing other entities? Okay, so we'll start the trade account, then next we'll look at the profit and loss account, then we'll finish with the balance sheet. So what is a trading account? Maybe before we can go into details, sorry, I was disturbed a bit. So before we can go into details, trading account and profit and loss account are collectively known as income statements. So of course, I mentioned that final accounts, there are three. There's trading account, there's profit and loss, there's balance sheet. So trading account and profit and loss account, these two are called income statements. Okay, so they are basically made up. The trading account is basically made up of nominal accounts. Remember the types of accounts. Nominal accounts are basically incomes and expenses, right? Then the balance sheet, on the other hand, is also known as the position statement. Okay, so the trading account and profit and loss account are collectively called income statements, and they are most of the times prepared together. So when they say prepare the income statement, they mean prepare the trading account and profit and loss account. Okay, well, the balance sheet is known as the position statement. So if the question says prepare the position statement, they are talking about the balance sheet. Okay, now let's just focus on trading account. What is trade? Okay, without trade, then we wouldn't be doing accounts. Trade is the buying or selling of goods with the intention of making profit. Therefore, the trading account is prepared to calculate the gross profit or loss of the business in a given trading period. The point of trade is to make profit, but sometimes you can make loss. So this account is prepared to calculate the gross profit or loss. What is a gross profit or loss? Okay, so gross profit basically is sales revenue minus cost of goods or cost of sales. Okay, so the amount of money you make from sales, you remove the amount of money you spent on the same goods. Okay, let's put it in a simple way, and I always advise you to take accounts in this way. Always try to be practical. Maybe some of you have not done business, but you know how business works. You buy an item, maybe a phone that is 1,000, right? So you buy it from town. Okay, so for you to take that phone from town to where you are, maybe transport is 20 kwacha, so total it's 1,020 kwacha. So this amount is the cost of goods or cost of sales. That is the goods that you are going to sell. This is the amount of money you have spent, right? Then you sell the phone. It means the total amount of money that you have spent on the goods sold, it's 1,020 kwacha. 1,000 for buying the phone, 20 kwacha for transport. Okay, then you sell that phone at 1,500. Okay, that 1,500 is the sales revenue. So the difference between the sales revenue, the amount you have sold the phone, and the amount of money you have spent to get that phone, okay, that is 1,000 plus that 20 kwacha, all the cost involved. The difference is the gross profit. So basically, in front of you is how a trading account looks like. So we have the title, Chipampe's trading account as at 31st February 20XX. So I like to use my students' names. Yep, this is my student. Also, 31st February. It's a funny date there. Anyway, this is how the layout is. Okay, there are different layouts, but basically this is it. So we have particulars, we have where we record different amounts. Okay, so most of the times using this approach, there's another simpler approach, but again, anyway, this is the one that we normally use, but there's even a simpler approach. Yeah, but just learn this, okay? Yeah, because this one will give you the full understanding of what's happening. Yeah, so sales. So you start with sales, okay? You want to know the amount you sold your phone, okay? So you sold your phone at this amount, you record, okay? Then you do minus sales returns. If there were some items that were returned, okay? If there were some items that were returned, maybe you sold the phone, then maybe the charger was not okay, so it was returned. So the person said, no, I need a 20 kwacha, a 200 kwacha to buy a charger from the amount I give you. Okay, so you have to subtract sales returns from the sales. Okay, the difference between the sales and sales returns is called the turnover or total sales. Okay, turnover is the commonly used term. Okay, so this is the amount you made from sales. Okay, next you look at the cost of sales. So the cost of sales now is that amount you used to go into town and also to buy the phone. So all the amount you spent in having that good ready for sale is cost of sales. It has to be subtracted from the money you made from sales. Okay, so less cost of sales. So we have opening stock. So opening stock are the amount of goods you started with in this trading period. Okay, so we started maybe with XXX. Okay, so I'm going to expand the phone analogy. Okay, so I'm going to expand the phone analogy so as to give you more insight into what's happening here. So let's say you sell phones. So in this month, you start with 3 phones. Okay, this is February. So January, maybe after January ended, you remained with 3 phones. So you started with 3 phones here, right? So these 3 phones cost, each phone is 1,000. So the total is 3,000. So during this month, you will buy one more phone, okay? So the total, you buy one more phone, you record as 1,000. Maybe you did not like the charger. Okay, this time I'm going to say headsets. You did not like the headsets, so you return the headsets to the supplier. Okay, so you bought the phone 1,000, but you don't like the headsets. Maybe they cost 500, so you return the headsets, and the supplier gives you 500. Meaning that you have to remove from that 1,000 the 500 that you have been given back. So you say less purchases returns. So you remove purchases returns. Okay. So from there, you are going to calculate the total purchases as the purchases, the 1,000 minus the amount that was returned, in this case, the 500, okay? Meaning that to buy this phone that you bought in February, it was just 500 because at first it was 1,000 minus the 500 for the headsets that you returned, okay? So the difference is the total purchases which you record here, okay? It seems like my table is not aligned properly, but anyway, this is the total purchases. You record it here, okay? So now to bring that phone from town to your business is what we call carriage inwards. The amount of money you spend to bring the item into your business. Okay, so you have to add it because it's part of the cost. For example, in this case, it can be transport. Okay, so we're going to include it. So to on that 500, which is the total purchases, which is this amount, we have to include the 20 kwacha for transport, the carriage inwards. Okay, so we include the 20 kwacha. Okay, So now the three phones we started with, which were costing 3,000, plus the new phone, which is 500 because we retained the headsets, plus the amount of money we spent to bring this new phone, gives us the total amount of items we have for sale, right? So that is called total stock available. So we add this number plus this number plus this number to get this number. Okay, so a recap of what we have done. First, we got the total sales, we recorded, we removed the amounts or the parts that were retained to us after selling. Okay, so we got the total sales or the turnover. Then we went to cost of sales. So we started with the opening stock, the amount of items we had from the previous trading period. Okay, then from that we got the we recorded the purchases, the amount we spent on items we bought this trading period. Then from the purchases we removed the amount we retained to the supplier. The difference was the total purchases, which is this. Okay, then we also added carriage inwards, the amount of money that was involved in bringing the item into our business, which is this. Okay, so after doing that, now we add the total, that is the items from the previous trading period, the items we bought, and also the cost of bringing those items into the business as the total stock available. That is the cost of the total stock available. Okay, so now the month has ended. We have to go and check after doing all the business, how many phones have we remained with after selling. How many phones have we remained with? Okay, so that is called closing stock. So if maybe two phones have remained, so we have to subtract the cost, or the value of those phones that have remained from the total stock available. Okay, think of it in this way. So we had 3 phones, we bought another phone, right? So we now have 4 phones, but we sold some phones. We don't know how many we sold, but we sold some phones. Okay, so how do we know how many we sold? We have to check how many are there. Okay, so normally we expect to have 4 phones. So if we go and check and find that we have 1 phone, it means 3 phones have been sold. Okay, so that's the thinking here. So at the total stock available, you remove the stock that you had at the end of this month. Okay, so once you remove, what you get is the cost of sales. It means if you have found that there is only 1 phone, it means 3 are the ones you sold, meaning that this amount of money you made from selling comes from those 3 phones. Okay, so let's close in stock. So what you get is cost of sales. Okay, so now to know the gross profit, whose definition is sales revenue minus the cost of goods sold. So it is this amount minus the cost of goods sold. Okay, so in short, you subtract the total you got here. You subtract the total you get here as cost of sales from the turnover. What you get is the gross profit. So I'm going to go through again. If you have understood, you can skip, but I'm going to go through again to give you the final picture. So I'll start with the analogy. Okay, you sell some phones, you have made some money, so you record that money here. Okay, then you have to check how much profit have I made. That's what you're looking for. So now you look at what you started with the previous month, you record that here. Then you look at what you bought this month, you record that here. Okay, including whatever cost you incurred in bringing those items in your business, which is the carriage inwards. Okay, so now this total cost now gives you the total stock available for that month, not at the end, but for that month. So this is the total stock that you had. Okay, if you had started with 3 phones, then you have bought 1 phone. Okay, so the total phones you had for that month is 4 phones. Okay, now you want to see how many phones have remained, so you have to go and check what is the closing stock right? So you find that there's only one phone, so you do less closing stock. So if there is one phone, you do the total phones you had minus the one phone that has remained. Okay, it means 3 phones were sold, so cost of sales is going to be the cost of those 3 phones that were sold, or the difference between total stock available minus closing stock. Okay, so now you sold 3 phones, you made this amount of money. What's the profit? The amount of money and the cost of the 3 phones you sold, which is this. Okay, so that's how it is. So you start with sales, you subtract sales returns, you get the turnover. Then you go to cost of sales. You start with the opening stock, then you go to purchases. Purchases, you subtract purchases returns. Okay, what you get is the total purchases you record here. You also include carriage inwards here. Okay, then you add. What you get is the total stock available. From the total stock available, you subtract closing stock, which is this value. Then what you get is the cost of goods sold, or cost of sales, which is here. Then the difference between the turnover and the cost of sales gives you the gross profit. Okay, so for those who may not know, when we put a figure in brackets in accounts like this, we're showing that this figure has to be subtracted from the figure above. Okay, so that's what it means. Okay, so this is how to do, this is the layout of the trading account. So now let's understand some terms. Of course, I've explained, but just for you to have a clear grip. Okay, so what is opening stock? So opening stock is just the value of goods in stock at the beginning of the year, of the trading year. Normally we record our books at the end of a trading period, which is most of the times a year. Okay, so so at the beginning of a trading period or year, what you have is the opening stock. The example was given was for a month. So in that case, the opening stock is the value of goods in stock at the beginning of the month. Okay, but basically the clear definition is value of goods in stock at the beginning of a trading period, because trading period can be a month, can be a week, can be a year, but most of the times it is a year. Purchases is total goods bought for resale, not the vehicles or the computers you want to be using to record your books of accounts. Total goods bought for resale, that is purchases. Carriage inwards is cost of transporting goods to the business. Closing stock, it's unsold goods at the end of the trading period or year. Sales is revenue from selling goods. Cost of sales is opening stock plus purchases plus carriage inwards minus closing stock. That's the cost of sales. Okay, and gross profit is sales or turnover minus cost of sales. So let's look at another example for you to appreciate now in details. So these are the records for this given trading period. We have sales, we have sales returns, we have opening stock, we have purchases returns, we have carriage inwards. Okay, so this is how we're going to prepare the trading account. Okay, so we start with sales, which is 80,000 minus returns, right? So returns were worth 2,000, so we record 2,000. 80,000 minus 2,000, we get 78,000. That is turnover. This is simple. To get turnover, you just do sales minus sales returns. If there are returns, if there are no returns, then you just have sales. Okay, there's nothing to subtract. No good was returned. The business went well. You sold everything. Okay, then we go to cost of sales now. So now the opening stock. Okay, the cost of the items you started with is 10,000. You record this. Okay, then during that year you purchased items worth 40,000. However, you did not like part of the items, so you returned them. The cost of items you returned were valued at 5,000. So 40,000 minus 5,000 is 35,000. So this is the total purchases. Okay, you bought 40,000, you retained 5,000. So meaning that the actual amount of purchase is 35,000. Then carriage inwards, which is the cost of bringing the items you purchased into your business, is 1,000, right? According to this, right? So now, when you add this, you get the total stock, which is 46,000. Now you have to remove the closing stock, the 12,000. Okay, so 46,000 minus 12,000 is 34,000. Therefore, the gross profit is 78,000 minus 34,000, which will give you 44,000. Hope my calculator was not deceiving me. This must be, no, it's not 44. 78,000 minus 34,000. Let me type again on my calculator. This calculator, I need to buy a new one. So we're talking about 78,000 minus 34,000. Is it? Oh, it is 44,000. Its meal is not good in the head. Yeah, it's correct. It's correct. Yeah, it's 44,000. Okay, so this is how to do a trading profit. It's easy. Okay, it's just go through the steps are same. Okay, you start with sales, less cost of sales, then you do your gross profit. Okay, so next we're going to look at the profit and loss. Okay, which most of the times is combined with the trading account, because this figure, gross profit, has to be connected to what we're going to do in the trading and profit, in the profit and loss account, to get the net profit. So see you in the next lesson.